Hi everyone, welcome back. Today in this video we are going to understand what is this matching concept that we have in accounting and how is it really used in the business. See, it's very simple. What this concept says is, see here, this concept states that revenue earned should be matched with the expenses incurred in earning that revenue. And both of these things, revenue earned and the expenses incurred to earn that revenue, should be reported in the same accounting period. That's what matching concept says. But now you will say, sir, we did not understand anything. Let's take an example. See, let's say you have a business and you want to apply the matching concept while doing the accounting of the previous year, 2020. That's your accounting period right now. Okay. So what are you going to do is you are going to take whatever revenue you have earned in the year of 2020. Okay. So you can say this is periodic revenue, right? You will take revenue earned. I'm saying earned, okay, not received. We are following the accrual concept. Yes. So revenue earned, and then you are going to take the expenses that has been incurred in the year of 2020 to earn this revenue. Expenses incurred in 2020 to earn this revenue. That's what you're going to take, these two things. Revenue earned and expenses incurred to earn this revenue, and then you are going to match these two things. You're going to match these two things. What does that mean, sir? Matching revenue earned and expenses incurred. You are going to do this, revenue minus expenses, and that's how you will be able to calculate the correct profit or loss for the period for 2020. Yeah, see, this matching happens. Now you see where this will happen. This matching will happen in the income statement, in the statement of profit or loss, profit and loss account also, you can say, to calculate the profit or loss for the period. Now the period could be 1 month, 3 months, quarter, or a year, isn't it? Yes. So this is what matching concept is. Now the main important thing is you have to take the expenses that has been incurred to earn that revenue. That's very important. Mainly matching concept focuses on that, because see, revenue which has been earned, this you will take based on the period. Period basis, periodic revenue you will take. Of course there is a criteria for the revenue recognition which you don't know right now, but there is a criteria. Based upon that you will recognize the revenue, periodic revenue you can say, and then you will match the expenses. Which expenses? Expenses which has been incurred to earn that revenue. Okay, after that you will be able to calculate the correct profit. And then see, both of these things, revenue and expenses which are related, should be reported in the same accounting period. If you don't do this, if you don't follow the matching concept properly, if you do not record in the same accounting period revenue and the related expenses, then what will happen? The profit will not be correct profit. The profit may be more than what it's supposed to be or less than what it's supposed to be, right? That can happen. Profit can be overstated or understated. That is why you have to follow the matching concept properly. What you have to do, you have to first take the revenue earned, and then this should be matched with the expenses that has been incurred to earn this revenue in the income statement, and both of these will be recorded and reported in the same accounting period. Is that clear? Periodic revenue and matched expenses. Now let's take a numerical example to understand this better, and you will be clear with all the doubts you have right now in your mind. Okay, so see this example over here, this boutique shop example. See here, let's say this is you, okay, and you have purchased, see here, you have purchased 100 pieces of dresses, various dresses, let's say, at 100 rupees each. This is your cost, isn't it? You have spent this much money. How much money you have spent? Understand each and everything properly. 100 dresses into 100 each, right? The price is 100, the cost price. So into 100, that's equal to 10,000. So 10,000 you have incurred. This cost you have incurred. Fine. Okay. And then you have sold 80 pieces of dress at 150. How much sales you have made? 80 pieces into 150 selling price, 150 selling price. So that's equal to 12,000. So 12,000 sales you have made, and cost was 10,000, and you have also paid rent of 1,000. Now tell me, how will you calculate the profit based on the matching concept? Will you do this? See here, will you take the sales first like this? See, 80 into 150, that's equal to how much? 12,000 was it, right? So 12,000 you will take, and then you will subtract the cost which you have incurred minus 10,000. You got 2,000, and then you will subtract the rent also because it's an expense, 1,000. You will subtract the rent also. So 1,000 answer you got. So is 1,000 your profit? Is this correct profit? No, it's not correct profit. Why? Because you did not follow the matching concept properly. What did matching concept say? Matching concept said that you have to take the revenue which you have earned. Yes, 80 into 150, this is your revenue which you have earned in the current period, but you took the wrong expenses. See here, they are saying expenses incurred in earning that revenue. You took the entire thing. You took the entire cost as the expense for the current period. The entire expenditure which you did, that entire expenditure, that entire money which you spent, you took that entire thing as an expense in the current period. That's why this is wrong profit. Let's just see what would be the correct calculation. See here, first what you will do is always first you will take the revenue earned. When you will see the income statement also, first you will have the revenue. Yeah, first you have to take revenue which you have earned based on the accrual assumption. Okay, not cash basis, accrual basis. So revenue 80 into 150. Okay, 80 into 150, that is how much? You all know 80 into 150, that's equal to 12,000, right? This is the revenue which you have earned. It doesn't matter whether you have received the money or not. We are following accrual assumption, right? So revenue which you have earned minus cost of goods sold you are going to take. Cost of goods sold, not the entire expenditure. The cost of only those items which you have sold. So how many pieces have you sold? You have sold only 80 pieces. So how much did you incur for that 80 pieces? How much cost did you incur for those 80 pieces? Only that you are going to take, not the entire thing. Yeah, this 100 into 100, this is 10,000. Yeah, this 10,000 is for all the pieces, for all 100 pieces. You are not going to take that. You are only going to take 80 pieces cost only. Okay, so 80 into 100, that's equal to 8,000. So 12 minus 8,000. Is that clear? That's how you're going to match. This is the correct matching concept, not the way which we did previously. 12,000 minus 10,000. No, that's wrong. You have to match properly. Okay, 12,000 minus 8,000. And then the rent as it is, because it's a period cost. So less rent 1,000. So 12,000 minus 8 minus 1,000, that's equal to, sorry, let me just calculate that again. 12 minus 8 minus 1, that's equal to 3,000. 3,000 is the correct profit. Now you will wonder, sir, what about the remaining 20 pieces? What happened to that? We only made calculation over here of 80 pieces only, but in my business, what about the remaining 20 pieces which I have not sold in the current period? Yes, the pieces which you have not sold in the current period, that's your asset. Future benefit is there from that 20 pieces. So you will take that 20 pieces to the balance sheet, yeah, as an asset, as inventory, current asset. You will take that in the balance sheet and it will be shown over there. See here, 20 unsold dresses are inventory which will be taken to balance sheet. So you will not expense this. You cannot expense this in the profit and loss statement, in the income statement. In the income statement, you can only take 80 pieces and expense that completely. Okay, not the entire 100. 20 will go to the balance sheet. And one important thing you have to understand. What did I tell you? I told you you have to take the expenses which are incurred in earning that revenue. But sometimes what will happen? Sometimes there will be some expenses, some cost which has been incurred, but you cannot directly trace them to the revenue. For example, the rent, yeah, period cost, rent, salaries, you cannot trace them directly to the product which you are selling. So you cannot directly match them to the revenue. You cannot do that sometimes, but still you will take that in the income statement. Rent, salaries, even though you cannot directly trace them to the revenue, you cannot do that, but still you will take. Why? Because of accrual assumption. Because these things have happened for the current period, yeah, we have to take them into the income statement. Is that clear? See, generally there are two types of cost. Product cost, which you can directly trace back. This cost of goods sold, 80 pieces cost, this is product cost. You can directly trace it, 80 pieces, yeah, and you can deduct them from the revenue. You can match them properly. But then there will be some, period cost, such as rent, salaries. These things you cannot trace them. How much rent you have paid for 80 pieces like that? No, you cannot trace them. It's not directly attributable. What you have to do, you have to directly, as it is, take it in the income statement, because it has been incurred in the current period. And of course, these have helped the operation of the business. So that is why you have to directly take them in the income statement. Is that clear? So this is what matching concept is. Always see the revenue first and then take the expenses which has been incurred to earn that revenue. Is that clear? So that's it for this video. See you in the next video. Bye.